Hi friends, welcome to Surreal Trader, and today I'm doing this video to explain how market makers really exploit the retail or dumb money as they call it. Now, a lot of people may agree or don't agree with dumb money concept, but or may even get offended. But what I mean to say is that typically, trading or stock market is a zero sum minus game in the short run. What it really means is that only a large number of losers are going to make some winners, right? So that's pretty much how the markets are positioned. It's in the short term, if everything stands equal, then typically nobody, money is not created, right? Money markets are the right term is money markets, and the right term is stock exchange. You are exchanging the value. There's nothing getting created because you only create something when the wealth is increased. But in the short run, the money supply in the markets doesn't increase. So how you can make money is by harming or other persons have to lose. So typically, I will pick the chart of Micron. We can actually take any stock, but I am taking Micron because this is something that I have been observing for a while, and we will look at it. So I have put a random system in it, and we'll see how this chart is completely random in the sense that we don't know what's going to come. Now, let us try and see what happens. So this is the NVDa fall. So market was going up. Now we got a signal here in this, and in the end, it met its target as well. But before it went up, it had a gap up, went up, and then the entire move was fizzled out. In fact, if you placed a stop loss somewhere here, or you actually were stopped out, and then the market made the move here. Similarly, recently, if you see, market was going up. A lot of people were thinking that the market is going to continue up. I mean, immediately there is a gap down. A lot of people who put their stop somewhere here or this candle's low or here, they were completely stopped out in this candle itself. Now, and whatever who were remaining, they were probably shaken out or they were also stopped out in the next candle. And then there was a massive 16-17% fall, the NVIDIA fall. And then the market is again kind of trying to regain that area. If you look at the smaller time frames, typically, when this fall may have happened, some people got their signal here. Next day, there was a gap up. People would have made money. But then a lot of people who entered late, they might have put their stop somewhere here or here. All those stops were taken out on this candle. If you look at the price action, this is a signal generation. There is a movement. Now you're thinking that the markets may continue. This is a bullish engulfing candle. So everybody is now thinking that the market should go up in this bullish engulfing candle. A lot of people will place their stop losses somewhere here, here in this range, and the market doesn't go up. Right after this bullish engulfing, the entire move is fizzled out, taking out all the new people who entered in this. And well, a lot of people would have entered on this bullish engulfing, and they would have placed their stop losses somewhere lower or somewhere nearby here. Or somebody who was brave enough would have put a stop order at a lower. They were survived, but all other people who entered late were taken away by this candle, and immediately as it touched this base, it again made a bullish engulfing and started going up. Now it's again going up, and then typically next day again, they again take out the stop losses. Again, the momentum builds up. A lot of new people enter. They put their stop somewhere here, and they are completely stopped out on this candle. And even some people who might have entered here, they are stopped out. They try to stop them out, and immediately on that candle, the buying happens, and now the movement is up. So typically, what is going on here is that these large institutions who are trading with a lot of capital, they know, they really, and sometimes these large players, institutions, banks might be operating in close coordination, right? And they have a mechanism. Order flow is shown to them as to what prices stop orders are placed. They will, whenever you're putting a stop order, it knows, you're telling your broker that it's a stop order. Most stop orders are at the market orders. So typically all this information is with them, and they utilize this information to really gather whatever they want to buy at a lower prices. And once they are successful, they and then the market goes up. Having said that, operators also get trapped sometimes. There can be a counter operator who's operating against them. So, but this is typically what happens with most of the most of the times. So, and even if you look at the daily charts, right? So, a lot of people might have got bullish on Micron at this level, and they would have placed their stops. All those stops were taken in a flurry, and markets is again going up, and maybe it will make a new high. We don't know. But so, how do you survive this kind of a massive fall, or scenarios where you know that the trend is intact and emotionally it becomes very difficult to manage those positions? If you see, I'll show you the futures chart. So on futures, also these kind of things happen. Somebody can say that S&P 500 can't be manipulated. Of course, it can't be manipulated, but intraday, a lot of moves in intraday happen, which are operator driven or which are big player driven. Typically, let us see, suppose you get a buy signal here. Now the market is going up, and then suddenly you see this fall comes in, then you have this fall coming in. So all these kind of falls are basically to trigger the stop losses. So how do you manage these kind of situation? Let me show you the Nasdaq chart, because Nasdaq is highly traded. Look at that. You will see these kind of sharp reversals and then completely going in the opposite direction, happening on a regular basis in large indexes as well. Let me just remove my system. Look at this. So market, there was a sharp fall. Look at this. Market is slowly going up, and then there is a sharp fall, buying, again fall, and then market goes and again reaches the level where it was trading. Now in this particular fall, big fall, a lot of retail traders who were trading with stop losses, or some people who would gone long on this candle would have placed stop losses below this. All those people are whitewashed. They're completely out of the game. Again, market will perform normally, and then there will be a big fall again, and again then the market will start going up. But typically this is called as a stop loss hunting. It happens on all time frames. Now see this particular scenario. Market, somebody went bullish, a lot of people are entering. Now market gives a buy signal as well, and then this buy signal is intact. But then market is going up. Before it goes up, it makes another big fall, and further fall, takes out all the stop losses, and then again the signal continues and makes and probably meets its target as well. Again, you see, you get a signal, bullish engulfing, pattern is up. Now again there is a stop loss hunting. So how do you manage this kind of scenario? Is by hedging. Number one, in my personal opinion, you should not be doing anything like intraday or all. Even in intraday, these falls happen, or even on 5-minute charts as well. So you can just increase your time frame, and you, rather than using stop losses, you can start using hedges. And once you start using hedges, and typically, the concept of hedge is that you are buying a counter trend or a counter trade, which will ensure that just in case something happens against you, or the market goes against you, you cannot lose more than what you have planned for. So it's basically buying insurance. So if you are interested in that, you can comment and you can follow me. You can join my futures channel, and we can discuss about how to hedge your positions both for stocks and for futures.